what do you do, right? If buying an option is too expensive, in this case, let's say a call or put, what do you do? So here is the chart of Netflix. So one of the things about Netflix is the trend is up, and now we've got some type of consolidation pattern. So first of all, we're going to trade in the direction of the trend. So I don't believe in that question. It actually, this member actually asked if it was a call or put. So I'm just going to look at a call trade. Why a call trade? Because we're trading to the upside. And why are we trading to the upside? Because the trend is up. We trade in the direction of the trend. Now, it's consolidating out of the moment. So what we're trying to do is we want to get in this trade in anticipation of the breakout of that pattern. So let's go look at the chain on Netflix, the option chain. Okay, so going back to the question, and I have a bunch of things pulled up, they're very expensive. The ATR stands for the average true range. For those of you that don't know what that is, it's 9.26. That means this stock moves on average $9.26 a day. And when this member did the theoretical pricing model, we have videos on the theoretical pricing model. A $4 move just wasn't going to give enough profit. Okay? So, just kind of wanted to mention that. Now, let's go here. So what I'll do is, let's say I'm going to go here to this 18 days, okay? Depending on what trade, but we have a strategy called the average true range. And we like to play around that 14-day mark-ish. So let's just look at the April right here, the 26th April, 18 days. So if I'm looking at a call, let's just say, you know what, I like to look at around 2 strikes out of the money for this strategy. So right here, well, look at that. 1575 is the bid, right? And 1595 is the ask. So for those of you that know how to trade options, that means one option contract is going to cost $1,595 if I pick it up on the ask. And if I pick it up on the bid, it's going to be $1,575. For some of you trading a smaller account, that might be too much. So what do? Here is another option that you can do. First of all, if your bias is up, and we've already looked at the chart in Netflix, so we are trading to the upside, what strategy can you do? Again, we're not going to do an iron condor because our bias is up. It's consolidating at the moment, but we're expecting a breakout at any time to the upside, okay? Now, be mindful, earnings is coming up, so you just want to be mindful of that. Okay, but for demonstrative purposes, what can we do? So if we're going to trade to the upside, we could trade a call. Well, we just saw that trading a call was too expensive. So what is another strategy that we can do that we're going to trade to the upside, right? Well, another one is a debit vertical spread. A debit vertical spread is a credit, well, it's not a credit spread. A debit vertical spread is basically you're buying a call, but then you're also selling a call at the same time. But when I do a debit vertical spread, my bias is still to the upside. Well, in this case, I'm going to be doing what's called a bull call spread. Okay, bull call is a bullish strategy. And the way it's going to work is you're going to sell a call, right? You're going to sell a call, and then you're going to buy a call at the same time that you sell the call. And so in this case, if I was doing a bull call spread, I would sell, let's just say the 370 since that's right there. We'll look at the chain in a minute. And I would buy a strike underneath it. This creates my debit vertical spread. And by doing a debit vertical spread, what you've done was you've created a defined amount of money that you can lose. Okay, it's got a defined maximum loss. But with a debit vertical spread, you have a defined amount of money you can make. As opposed to a call, if you buy a call, it can be unlimited in your gains. Well, debit vertical, it has a maximum amount of money you can make. But it's a higher probability than a call, okay? So in this particular case, we could look to buy a debit vertical spread because, again, our bias is still to the upside. So if we look at buying a vertical spread on Netflix, what I like to do is I like to sell that first strike out of the money. So if you see the first strike out of the money, it's the unshaded area. So that would be the 3, 6, 2, 5. So right-click, and we're going to buy a vertical. Now, I need to make a couple of adjustments because, again, what this strike is, the 362.5, that's the strike that we're going to sell, 362.5. So 362.5 is about right here-ish. We're selling that strike. So first thing is we're selling that first strike out of the money. But you have to actually put right-click buy vertical. Then you're going to change your numbers. So this strike right here where it says I'm selling, if you notice it says the 65, I have to make that adjustment. 362.5 is what I'm going to sell. So I'm going to sell the 362.5. Now it looks weird because this also is a 365. So now what I'm going to do is I'm going to buy that first strike in the money. So you sell the first strike out of the money and you buy the first strike in the money, which in this case happens to be 360. So I'm going to change this to buying the 360. Now, if I do that, the first big thing you notice is it creates a debit of 127. And it's changing right now, 128, because the market's open. But what that means is that's right now $128 a contract. So if I just buy the call, it's $1,595 a contract. But if I did this vertical spread, it's only going to cost me $128. Now, by doing the debit spread, I'm creating a maximum amount of money that I can make. So if you want to see what that is, I'll tell you and then I'll show you in easier ways. You take the distance of the strikes. So the strike is $2.50 wide. I am going to pay $128. So the difference, if I take my calculator, $2.50 minus the $128, the difference is $122. Okay? So my maximum gain is $122. So in this example, assuming the price doesn't stay the same, my maximum gain is $122, right? We just talked about that. And then my maximum loss is what I pay. So I'm going to risk $128 to make $122. So you can actually just leave this like this and hit confirm, and then you can look at the numbers, and it tells you exactly what we just said. Maximum loss, well, it says 129, because again, it's changing, right? So that's going to change, but it would have been 128. So as of right now, it says maximum loss 129, maximum profit 121. And so if that trade hits, okay, and I'll tell you what you got to do to hit, which means win, is it's going to give me roughly a potential 93% return on my money. So what makes this trade a winner? What will make this trade a winner is if the strike by expiration stays above the strike that you sold. So if I sold the 362.5, Netflix is at 361.17. So if it goes up basically another $1.40, all Netflix has to do is go up $1.40, and then it can go flat. Now, I prefer it to continue to go up, but it can go sideways. If it does that, I'm going to get maximum gain, which in a minute ago, again, it'll tell you your maximum gain is 121 in this case. And what is that? It's because it's the difference of your debit and the strike. So I can make $121 to risk 129. So if I was willing to risk $500 on this trade, I can't buy the call because, look, again, it's very expensive. Then I would take my maximum loss, which is 129. So I would do $500 as my risk divided by 129, and that's 3.87. I round down, that's 3 contracts. So I would be able to buy 3 Netflix contracts, and here it is. Maximum loss, 387. Maximum profit, 363. So it allows me to trade Netflix even though it's so expensive. So whenever you're trying to trade an option on a stock and it's too expensive, this is another I guess, thing that you can do, another option, okay? Now, I have specific rules of what I like to look for, okay? In this case, it's 93%, but I have specific rules that tell me I cannot take this trade unless I have a certain percentage return on my money, okay? So I have specific parameters now, okay? But again, for this member's question, that is exactly how you do it. So, hey, $387, potentially $363, 93% again. So one more time, just in case you're scoring at home, you sell the first strike out of the money, You buy the first strike in the money. It creates this spread. This is the debit now, 131. Again, because it's live, it's changing. The debit is the amount of money that you're going to pay. And then the difference of that strike is the amount of money that you have potential to make. And how do you win on this trade? All Netflix has to do is go above 362.5, which is literally only $1 away, and then stay above that over the next 18 days. If it does that, I'll get maximum gain. If you'd like to learn more about trading options, I encourage you to check out my Options Elite Masterclass and all the bonuses that I'm giving away this month, like my TTM Squeeze course for free, plus that Forecast Pro indicator. I'm giving that away free this month to anybody who gets my Options Elite Masterclass. So check down below in the description if that interests you. Now, if you like the TTM Squeeze Pro indicator, click right here.